Looking at these numbers, this is either the worst possible time to be working a 9 to 5 or the best possible time to stop. Because while you're trading hours for dollars, watching your salary get chipped away by inflation, there's this one company that just delivered returns so explosive they literally broke my calculator. I'm talking about gains that could turn a fast food worker's monthly paycheck into more money than most people make in a year. The kind of returns that make your boss's salary look like pocket change. But here's the thing. This isn't about some crypto scheme or get-rich-quick fantasy. This is about one specific stock that's positioned at the center of the biggest wealth transfer in human history. Harry gets this. He started with just $2,000, money he scraped together from his construction job. Today, that investment is worth more than what most people make in 5 years. And the crazy part? We're just getting started. Because what I'm about to show you isn't just about one company. It's about understanding exactly why some people are building generational wealth, while others are stuck in the same financial hamster wheel, year after year. See, most people are investing backwards. They're chasing dividend stocks that pay them peanuts, while their purchasing power gets destroyed. Or they're buying these so-called safe blue chips that barely keep up with inflation. Meanwhile, there's this massive technological shift happening right under everyone's nose. And the companies that are powering this shift? They're not just growing, they're exploding. Let me paint you a picture of what's really happening in the markets right now. Dividend stock. Number 1. PennantPark Investment Corporation. On one side, you've got these traditional dividend darlings. Take PennantPark Investment Corporation. On the surface, it looks incredible. 14.4% dividend yield, monthly payments hitting your account like clockwork. But here's what they don't tell you in those flashy dividend newsletters. PennantPark's payout ratio is sitting at 131%. That means they're paying out more in dividends than they're actually earning. It's like using your credit card to pay your mortgage. It works until it doesn't. And their non-accrual loans? These are basically loans that have gone bad. PennantPark's sitting at 1.6%, which isn't terrible. Dividend stock number 2, Stellus Capital Investment. But compare that to Stellus Capital, another dividend favorite, where 8.3% of their loans have gone non-performing. These companies are essentially financial engineering their dividends. They're not creating real wealth, they're just shuffling money around, hoping you don't notice when the music stops. Meanwhile, Harry's construction worker's salary of $45,000 a year? To generate that same income from PennantPark's dividend, you'd need to invest over $312,000. Think about that for a second. You need more than 6 years of your entire salary before taxes just to replace your income. That's not financial freedom, that's a mathematical prison. But there's another way, and it starts with understanding something most investors completely miss. The biggest wealth transfers in history don't happen during normal times. They happen during technological revolutions, the railroad boom, the oil boom, the internet boom. And right now, we're living through the AI boom. But here's where it gets interesting. Most people think AI investing means buying NVIDIA or Microsoft. These trillion-dollar giants that move like glaciers. Sure, they might double your money over 5 years, but they're not going to change your life. The real money is in the companies that are building the infrastructure of this AI revolution. The picks and shovels plays that most people have never heard of. Growth stock. Number 1. Inodata, the AI data engine. Companies like Innodata. Now, before you roll your eyes thinking this is some penny stock pump scheme, let me hit you with some numbers that will blow your mind. If you had invested $10,000 in Innodata 5 years ago, you'd be sitting on over $331,000 today. That's a 3,212% return. Read that again. 3,212%. But wait, it gets better. This isn't some flash-in-the-pan crypto-style pump. Innodata is a real company with real revenue, real profits, and real growth. They just reported Q1 2025 revenue of $58.3 million. That's a 120% year-to-year increase. Their net profit margin? 13.35%. The industry average? Negative 17%. While their competitors are burning cash, Innodata is printing money. See, while everyone's obsessing over ChatGPT and which AI chatbot is better, Innodata is solving the unglamorous problem that makes all of this possible. They're the company that takes raw data and turns it into the fuel that powers AI models. Think of it this way. OpenAI gets all the headlines for ChatGPT, but ChatGPT is useless without massive amounts of clean, organized, labeled data. That's where Innodata comes in. They're like the oil refineries of the AI boom. And here's the beautiful part. They're not just riding the wave, they're positioned to benefit from every single major AI advancement. Whether it's Google's next model, Amazon's AI initiatives, or some startup we've never heard of, they all need what Innodata provides. The company just secured a second master statement of work with their largest customer, essentially unlocking access to a materially larger budget within that organization. They've got $8 million in new engagements locked in, with potentially $30 million more in the pipeline. But here's where this gets really interesting for someone like Harry, or anyone else tired of trading time for money. Innodata's customer concentration, which some people see as a risk, is actually their biggest advantage. They've built such deep, integrated relationships with major tech companies that switching away from Innodata would be like ripping out the foundation of these companies' AI operations. These aren't transactional relationships. These are strategic partnerships that get deeper and more valuable over time. The more AI these companies build, the more they need Innodata. And we're still in the early innings. Analysts are forecasting that global generative AI spending will hit $644 billion in 2025. The services segment, where Innodata operates, is projected to grow by 162.6% this year alone. Think about that number. 162.6% growth in a market that's already massive and getting bigger every single day. Growth stock. Number 2, Astera Labs, the infrastructure play. Now, you might be wondering about the other players in this space. What about Astera Labs? They're another AI infrastructure play that's been getting attention. Astera Labs is interesting. They're building the connectivity solutions that power AI data centers. Their revenue grew 242% in 2024, and they just turned their first quarterly profit. But here's the thing. They're trading at 32 times sales. That's expensive, even for a growth stock. Meanwhile, Innodata is trading at just 7.6 times sales. You're getting similar AI exposure, similar explosive growth, but at a fraction of the valuation. Plus, Astera Labs faces intense competition from giants like Broadcom. Inodata? They've built such specialized expertise in AI data preparation that they're essentially irreplaceable for their clients. Hybrid stock, Fiserve, the stable giant. Now, there's also Fiserve, the fintech giant that's quietly building the future of financial technology. With a $92 billion market cap and consistent growth, they're launching their own stablecoin and positioning themselves at the center of digital payments. Fiserve offers stability with growth potential. Their 37.8% operating margins and sticky customer relationships make them a solid wealth-building machine. But here's the reality. They're not going to deliver the explosive returns that can truly change your life. Now, I know what you're thinking. This sounds too good to be true. There has to be a catch. And you're right to be skeptical, because the truth is most people won't make money from this opportunity. Not because the opportunity isn't real, but because they'll sabotage themselves along the way. They'll see Innodata hit a rough week and panic sell. They'll read some headline about AI being overhyped and dump their shares. They'll get shiny object syndrome and chase whatever stock is hot that week. See, explosive growth stocks like Innodata don't go up in a straight line. There was a point where this stock dropped 74% from its highs. Imagine watching 3/4 of your investment disappear. Most people would have sold at the bottom and sworn off growth stocks forever. But the smart money, the people who understood what they owned, they either held on or bought more, because they knew that temporary volatility is the price you pay for life-changing returns. Harry understood this. When Innodata hit its rough patch, he didn't panic. He didn't sell. He remembered why he bought in the first place, because this company was positioned at the center of the biggest technological shift of our lifetime. And that conviction paid off, because while his co-workers were complaining about their stagnant wages and wondering if they'd ever be able to retire, Harry was watching his small construction worker investment grow into something that could change his family's trajectory for generations. This is what real wealth building looks like. It's not about clipping dividend coupons or buying index funds and hoping for 7% annual returns. It's about identifying the companies that are going to dominate tomorrow and having the conviction to hold them through the inevitable volatility. But here's the thing about opportunities like this. They don't last forever. Right now, Innodata is still relatively unknown. They're not on CNBC every day. They don't have millions of retail investors piling in. The big institutions own 56% of the company, but there's still room for individual investors to get in before this story becomes mainstream. Once Innodata hits the mainstream, the easy money is gone. The stock will be priced for perfection, and the upside will shrink. This is your internet moment. Your chance to ride a technological wave that's creating more wealth than anything we've seen in decades. I'm not saying bet everything on one stock. That's gambling. But if you're serious about building wealth, you need exposure to companies shaping the future. Harry started with $2,000. You might have $500 or $50,000. The amount doesn't matter. What matters is this: massive opportunities come with volatility, and those who understand the trend win big. Innodata isn't just a stock. It's a thesis on AI, data, and the infrastructure behind tomorrow's biggest technologies. That thesis, it's already delivering life-changing returns. The only question is, will you act before the rest of the world catches on?